Here at Chapman Albin, we talk to folks every month about the problems and losses they've experienced as a result of investing on margin. If you're not careful, margin trading can destroy your net worth. Allow me to explain what it's all about. Trading on margin just means you're investing with money you borrowed from your brokerage firm. The brokerage firm loans you money on margin so that you can invest it in the stock market. If you have $100,000 invested with your brokerage firm, you can offer those investments to your brokerage firm as collateral for a loan. It sounds great, right? Not so fast. Margin trading is complicated and incredibly risky for you, the investor. It's never particularly risky for your brokerage firm. They rake in extra commissions when you invest the money they lent you. And they also charge you a high interest rate on that money. If the market tanks and you lose the money you borrowed on margin, you'll be personally on the hook to repay it all. The brokerage firm always gets paid with interest. You, the investor, don't have the same guarantee. Think about this. With margin trading, you can lose money even if you made a moderate gain on your investments. You may be asking, how can I lose money in an up market? The answer lies with the high margin loan interest rates. Remember, you're paying the brokerage firm interest on the money it loans you. If your loan costs are higher than your investment returns, you're losing money. Right now, margin interest rates are as high as 9%. So if you have $100,000 out on margin, you're paying your brokerage firm $9,000 per year in margin interest, meaning your investment would need returns that exceed 9% to make more money than if you had invested the original $100,000 without margin. That is a high hurdle. Equities have returned about 7% on average over the past 70 years. And in addition to these tough odds, you, the investor, personally guarantee that you will repay every penny of the margin loan with interest. If the stock market tanks and the values of the securities you pledged as collateral drop below your loan balance, the bank will make a margin call, forcing you to bring it back up to the required amount immediately. Let's say in a down month your $200,000 in investments have lost 20%. Now your account is worth $160,000 and you only have $60,000 in collateral. $160,000 minus the $100,000 that you borrowed. The bank will make a margin call requiring you to bring your collateral back to $100,000 to cover the loan. One way you can do that is by simply depositing $40,000 in your account. But most people don't have a spare $40,000 lying around. So instead, they have to sell $40,000 of investments they borrowed on margin to bring the collateral back to $100,000. And don't forget, every month your returns don't beat the interest rate, your account continues to go down in value. And as it does, you have to keep meeting margin calls, and the returns you need just to make the interest payments keeps going up. A single down month can have catastrophic consequences, causing large losses in your margin account to snowball. In a worst-case scenario, you could end up losing your original $100,000 and owe $100,000 to the brokerage firm for the loan. You, the investor, are responsible for that money immediately. There is no payment plan and no ability to negotiate terms. Brokers can take you to court to seize any of your other holdings to satisfy the margin loan. And that is why margin trading is almost always a bad idea for the average investor. It can quickly lead to a financial disaster.